Hello and welcome to FT Markets. Global equity markets have suffered their worst start to a year in recorded history. Investors are shunning stocks, selling commodities and selling risky bonds. Joining me now to discuss why we should be concerned, or perhaps not, is Dan McCrum, our capital markets editor. Dan, welcome. Should we be worried?
Well, I think there are two things going on here, Mike. One is what we're calling a cycle of pessimism. If you look at screens and you see the prices of stock markets falling, bond prices falling, the oil price in particular, we're back to a 12-year low. And for the last 18 months, people have been scratching their head and saying, what on earth is going to happen to oil? And the price moves ever lower. That isn't an environment in which you are going to be ready to stand there and buy things. And you're probably starting to get nervous about the outlook anyway. And then you have the real economic fundamentals, which are causing people concern as well, centered primarily on China. People are worried about the state of the Chinese economy. We had a decent growth number there from China today, but I don't think people really believe it. And what they are looking for is something which is going to turn this around, which is going to turn market sentiment, be it some good economic numbers, some good corporate profit numbers, or maybe even some action from central banks.
Now, you raise a very interesting point about central banks, because we're now in an era where, I suppose, arguably the most important central bank, the Federal Reserve, actually raised rates last month and has essentially moved away from an easing cycle into a tightening one. You've got the ECB still easing, we've got Japan still easing, although if you look at the performance of their stock markets so far this year, amongst developed world equities, they've been amongst the worst performers. What can central banks really do here?
Well, this is a question we're hearing a lot from investors at the moment. They're worried about the tools which these central banks have left available to them. In August, China started a bit of a sell-off then when it suddenly devalued the Chinese currency by quite a small amount. But that was enough to raise concerns about the direction of China, and it was enough to prompt the Federal Reserve to hold off on that first raise in interest rates. Now, it has raised. If things get worse, the question is, well, what does it do now? Does it go back on itself? And people are looking around the world saying, well, central banks have pretty much done everything they can for several years now to stimulate the economy. If it turns down now, what happens? And then we look at China and we think, well, it's almost the last thing you want is another policy announcement from the Chinese authorities, because we've had so many of them. And there's a sense that they're probably not going to do anything immediately, because we have Chinese New Year coming up next month. And also China is going to be hosting the meeting of the G20. So in these big sort of flagship events, China tends to suppress volatility and at least present to the outside world this face of calm, cool control of the economy and the system. But I think there are very real questions being asked by investors now about, well, what does the future look like? And they don't seem to be assuming things are going to get worse, but they're uncomfortable with what would happen were things to get worse.
So in effect, any kind of short-term rise or rally we see in markets, in your view, is that a short-term trading opportunity, but not really a long-term?
What I think one of the most interesting things to observe about markets here is that volatility hasn't really picked up yet.
Yes, that's a very good point.
Volatility is up a little bit, but when you look at the convulsions the market went through back in 2008 and back in 2011, in August, we aren't seeing that same amount of sort of motion in the market.
Pure panic selling.
And what that can suggest is that this is a fundamental reassessment of markets. You're getting a slow, steady withdrawal of people from the market, possibly even sellers. And that is different to well, this is just a temporary moment and we should all pile in and carry on.
Well, thank you, Dan. Lots of very interesting points to consider for investors as the year continues.